All righty. Good evening, everyone. Welcome to the trade findings and adjustments for, let's see, it's the 6th of October. Just as a heads up, I'm pulling the commentary. I've got the wrong weeks. I was so emotional and so into it that plain and simple, I just messed up last night. I've got the wrong week for financial reports. I was just off my game. So we're going to go through round 2 on the biggest danger on how options and option spreads, are dangerous. Yeah, good spelling there, Hurley. Come on. Give me a... Did I spell it right? I don't think so. I'll work on spelling when I'm done. So if we had a 409, 410 bull put spread for, on this case, a whopping 14 cents of credit, you have a 409 long put, which is the right to sell a stock at a certain price for a certain period of time. Simple, easy. And you guys are typing stuff in, so let me see what you're doing. Thank you, Lee. All right. So that is supposed to be your protection for a 410 short put, which is the obligation to buy a stock at a certain price for a certain period of time. So in this trade, what is your risk? What is your risk in this trade? Think about it. If you're thinking about it, what is the risk in this trade, right? And I'm going to do the best I can to do it in a, hey, here's what it could happen, right? There you guys go. Perfect. William, you're exactly right. Marion, David, perfect. Your risk is you have to buy stock at $410 a share to then turn around and sell it for 409, right? Which equals you lose $1. And that is how we all understand spreads. That would be our risk. We think we're okay. We are good to go. But the real risk is at options expiration. Because after hours, the stock price can fall, and you then have a long option that will show that it has expired, and a short option that you have to fulfill. Come on, get out of my way. fulfill the obligation without the downside protection. And that's it. You are completely hosed. So what happens is after hours, Tesla could fall, and I'm just going to do simple math here. Tesla could fall $70. Let's do the real. 418 minus 356, $62. The clearinghouse requests fulfillment (1.5 hours or more after options expiration on Friday, and the brokerage has to find accounts to fulfill those orders. Now, the problem is, right? The problem is that the long side shows an expiration, and the computer is too effing stupid to see the spread that was in place. In fact, the orders are viewed at expiration as separate orders. So if you were to say that to me or explain that to me, I would say, well, where the hell is the fiduciary responsibility, right? My question is, where is the fiduciary responsibility of the brokerage house, right? Where is the fiduciary responsibility of the brokerage house? But remember, they just see these big orders with sheets and just it basically says, hey, on one side, you've got 1,000 orders that have to be filled with another side. And they just look at the bottom like an accountant that says, all expirations were fulfilled by all options or money in the accounts or stock ownership. And they're just looking at the bottom that says 0 equals 0. They're not looking at where it's all at. In fact, I'm going to go so far as to say, my belief is that within the computer program, the first accounts to look at are the smallest. Why would they look at the smallest accounts? Think about it. Why would they look at the smallest accounts when in reality, it's probably the bigger accounts that can handle it? It's the bigger accounts that it won't cause a divorce. It won't cause a spouse to be yelling at the other one. It won't ruin a retirement. But why do you think it's the smallest accounts that are going to get hit, and then it's programmed in here to start looking at really $50,000 or less? Then if you can't find those accounts, then you go to $100,000 to 50,000, then 150 down to 100. I bet you there's some algorithm that finds this, or some computer setting that's programmed into it, but perfect. I see two of you answering because they generate the smallest amount of commissions. And those are trading commissions, right? I agree. I agree 100%. So what happens in plain English? Tesla's fallen. If you have a small account, I'm going to say $100,000 or less, you are probably more at risk than everybody else. And so you're looking at these positions, and all of a sudden, you are required to buy Tesla at 410. And the long put that you had is expired worthless. So at expiration, it is a double edge sword, where the long is expired and the short is still in play after the market close. It is ridiculous. What does this mean for let me go down a little bit more here. What does this mean for a bear call? Let's do a 410, 409, right? So the 410 is the right to buy a stock for a certain price for a certain period of time. The 409 is an obligation to sell a stock at a certain price for a certain period of time. So if a stock price takes off, you could be obligated to sell a stock at 409 and have to go out in time and buy it at maybe 500. This is what happened to a friend. Baidu took off over the holidays, had naked shorts, literally was buying the stock at like 385 to turn around and sell it at 250. It was a ridiculous problem. Margin requirements on the account are null and void. So even if they offered you 50%, you could be held liable for hundreds of percents on your account. The margin requirements, what you signed that said you can't go over 50% margin that they gave to you, they don't honor. Those are all BS. Not there, not honorable. As I spoke with FINRA for a bull put to avoid this after hours, so my clients have to go exercise a long put, which again is the right to sell stock they don't own. Naked short, right? In hopes that they cover the short put buying stock obligation. The answer was yes. That is one way to protect the account. And I'm not even going to tell you what my answer was, saying, all right, so you're going to protect an account by creating an unlimited risk scenario. To protect from an unlimited risk scenario that the brokerage house has put them in. Because the brokerage can see in their account if they have a long position covering the short. In fact, the brokerage has margin agreements that are signed that prohibit just this kind of thing from happening. So next time you sign one of these, be like, hey, can I have this in writing that you will keep me from never going above this so that if this happens, I'm covered? Oh my gosh, it's shocking. It is absolutely shocking. Which brings me back to my next comment. And I can't say it any better. Everyone who has told you I get paid to play, the biggest winners, which is totally garbage, but the biggest winners receive credit into their account, or most profitable option traders sell options, all completely BS. That's bullcrap. That is, when you hear that, just understand you have heard the biggest crock of crap you've ever heard in your life. If my wife wasn't in here, I'd use the 4-letter S word. That just means I'm sick. That's just sick. I think she's looking at me and saying, yeah, that's not the S word you wanted to use. But it is a 4-letter word. This is the risk with a cheap broker. You pay for what you get. I would put Robinhood in here. I just heard of one called Chewy. These are the kind of things that you can expect with these brokerage firms. Now, that doesn't mean Schwab, Fidelity, TD Ameritrade, or E-Trade will protect you, because they will not. For a fault or a problem within their system, you're hosed. You're absolutely hosed. So, I didn't understand that, but the real solution is to exit the trade before options expiration, even if you are going to lose a couple of cents and create another trading commission for the brokerage house. You are not at risk in calendars. You are not at risk in bullish positions. But yes, and in all, Ida, you just made the comment, it's safe to buy to close a short side before expiration. But yes, but you might as well close the whole thing. In all honesty, it doesn't make sense to let the long side go an extra penny or two either. Close the whole thing. Just close everything. But yes, specifically, you need to close your obligation. Close your obligation, get out of it. Leave a couple pennies. It's got to be 2 to 3 cents, maybe even a nickel, which makes a 14-cent credit trade look really dumb. It was 14 cents because obviously they went through, I don't know, that's not true. It had to be less than that. No comment. But what I'm trying to say is I won't get into a credit trade without at least 40 cents of credit. And I've usually tried $1. If I can't get $1, a credit trade doesn't make sense to me, because I could spend $1 and have a hell of a lot less risk. I would much rather do bull calls all day long over credit spreads. It's just common sense. People have asked me, well, Kevin, are you going to place a trade right now? No. If people are creating or placing new trades in the last 6 weeks and going to do the next couple weeks, you're not trading, you're gambling. Any trades that have been out the last 10 weeks that will expire November or sooner are dumber than dirt trades. You're gambling. We're here to invest. We're not here to gamble. We're here to create some wealth. Some of you are going to be waiting with myself. There are 4 of us plus myself waiting for Boeing. That is a long-term wealth creation position. It's funny, I've had a couple good talks with Bill, with Rich, with Dave, and with William. We've all come to the same conclusion. If people are doing trades really since mid-August, September, October, especially on the education routes, they're paper trading. They're paper trading. The only one that I know of other than myself is Guerrilla Trades. It's taken a step back and said, hey, we need to take a step back from placing trades. Partially because he's getting his ass handed to him. But someone that's trading real money, they take a step back. Not that you can't make money up, down, or sideways. Not that you can't make money in any direction, but the probabilities and the volatility are stacked against you. It was really cool as I spoke with Bill 4 or 6 weeks ago. He's like, you know what? I think I'm not going to place any more trades. William, I'm going to give you credit because I know you do like to trade. Congratulations for jumping onto the callers, and congratulations for having the fortitude to step back, William, and to decide, you know what? You're making sense. And then Dave, I know you like to trade a lot as well, and I know you step back as well. Yeah, we talked about it. You might have missed the last 2 weeks of August, but you were set up so bullish. I can very easily tell you, you probably saved yourself 20% of your portfolio, or the $25,000, to be honest with you. And you can work those numbers, and they're going to tell you exactly what I just said. The numbers don't lie. You want to see someone that's truly interested in your growth and your ability to trade for a profit. They would have called you off 4 to 6 weeks ago and said, with the elections and with COVID and stimulus and with things that are going on, there is no market direction. Covered calls worked well. We took a great profit on all of our covered calls across the board. They're working. We've also taken profits on most of our long puts, that there's some that we're losing on. And it's just common sense. I'll be honest with you. If you hear someone that's talking about placing trades every week and they're worth all this money, if it was real money, they would have been really presented with one hell of a contract to make a crap load of money by Goldman Sachs. I know I was presented with one at a time. I know the big money makers are always actively looking at accounts and watching what people are doing. We get to see it through the Security Exchange Commission for the state of Utah. I get to see whatever everyone's registered in Utah, exactly what they're making and how they're doing it. If someone really was making a 2,000% return, guess what? We'd all know about it. Guys, I'm going to pull the video from yesterday. I'm going to show this one today. I apologize for last night. Some of you, I'm sure, got a good kick out of it. I apologize from last night. Not only did I have options expiration and not earnings, but economic reports wrong, I just was not in the right frame of mind. As I had to go through these calls with these individuals, one held up very well. One, it probably just cost him his marriage. The way that his wife was flying off the handle, it was ridiculous. I had to make these calls with my compliance officer with me so that the state of Utah could understand that it wasn't me that told him to get in these trades. It wasn't me that put him there. I was just trying to help them find a way out of a bad position that they put themselves into. And I was worried that they would then complain against me that I somehow had cost them money. And one of the guys politely said, I thought you said you could get me out of this. And my answer was, well, I never said I'd get you out of it. I thought we'd find a way to get you reimbursed for this from the brokerage, but I was wrong. There is nothing that they will do for you or that they have to do for you. 31 years in the market, 18 doing options, 22 in trading. I was taught something new. And boy, Stuart is in trouble. Stuart's in trouble with how to find $138,000 before it goes to collections. He's in trouble with his spouse. It's amazing how the stock market at times can ruin people's lives. You have got to be smart with what you're doing. this is by far one of the hardest examples I've ever had to go through, because I've seen people blow up portfolios, get divorced, lose their house over naked short calls. This is different. This is the protection in my mind should have been there. This is something I have done in the past. This is something I've tried to avoid in the past, but I have never understood why and put two and two together. Absolutely shocking. Absolutely shocking. And it is something that I'm going to make sure I do a better job of voicing and helping people understand in the future. Guys, I know for some of you this was a repeat. I am sorry for having you go through it all again. Again, I feel I need to pull last night's video and readjust the economic reports because I was off a week. I just wasn't there, and I will do so. Do read the rest of what happened down below. Read their thoughts, read the response from Robinhood, and understand that this can happen to anyone. Any questions I can answer for you guys, or can we just call it a night? Can we call it a day? Can we just say we're good? Call it a day. Thank you, Maud. I appreciate it. And thank you, Mary and William. Appreciate it. Anyone have any questions, though, that they'd like to understand? I think I've done a better job of diagramming out and explaining the risk for your credit spreads. And this is what I want to get people to understand. That in all honesty, after hours, and I don't know how the hell you would exercise after hours, to be honest with you. I know you can trade after hours, but I didn't know you could trade options after hours, in which case you can't, but you can exercise or be assigned after hours. So I need to find out how you can exercise an option after hours. That might be Thursdays. But with that said, understanding the risk, I think, is one of the biggest battles of being in the stock market. Understanding where you can get hosed legally by the wolves of Wall Street. This is it right here. This is it. This is why options are risky. This is why you need to take your credits and your credit spreads, so to speak, not your credits, but your credit spreads, and close them out before options expiration, because the risk is too great. Guys, have a good evening. I appreciate you putting up with me 2 nights in a row. I'll make the changes on the videos most likely tomorrow. Take care. Have a wonderful day, and I'll look forward to seeing you Thursday morning. Goodbye, everyone.